Example 11.1. Consider table 11.1 below, which shows income statement for MKZ Airlines for years 2020 and 2021. Consider two scenarios, one in which the company took a debt and one in which it did not. In which case did the investors receive more money? Now we're talking about equity investors from the company, dividends or interest payments. So from equity investors perspective versus the debt investors perspective, and already copied these numbers onto here. So let's just see, this is revenue, this is cost of revenue, this is earnings before interest and taxes, and there is interest expense, earnings before taxes, and there's tax expense, which is 20% of the EBT, and then we subtract the tax from the earnings before taxes to get the net income, earning after tax, or net profit, whatever we want to say. So let's just go over it. So this is earnings before interest and taxes, so equals that minus that. And let's just assume the interest expense of 60. It's coming from the bank or whatever the loan terms are. And then earnings before taxes is this minus this. And then taxes equal to 0.2 times that. And then equals that minus that. That's how we get the 152 that we get here in this cell. Now the fun starts here. So we have three scenarios. All the formulae are same, as you can see. So 1000, this is 2020 with part debt, without debt, with all debt. Revenue, cost of revenue. The difference of the two is earnings before interest and taxes. We've deliberately not put the interest expense numbers yet, but we'll be putting them in a minute. And then this is earnings before taxes, which is the difference of earnings before interest and taxes and interest expense. And the tax rate is 20%. 20% of EBT is the tax. And then take the tax out from EBT to get the net income. All right. With that in mind, now let's go. So with all debt, this has to be 0. So how much should the interest expense be? Well, all the 75. So if we spend $75 on interest, our earnings before tax is 0, tax is 0, and net income is 0. Now here, in this column here, we have to make our interest expense 0. So this is without any debt. So with all debt, with no debt, we only pay our taxpayers $60. Now let's compare. Let's compare the $60 with the $75. Now, who is the net winner? The net winner, or who are we promising more payment? We're promising a payment of $75 to our bondholders and only $60 to our stockholders. And everything else is the same. So what we're trying to illustrate is that for the same net income and cost of revenue, we end up paying more to bondholders just because of tax savings. And how much is this tax savings? It's the $15, right? Is that $15 that we, $15 is the difference of 75 minus 60. That's the $15 saved. Now let's do one final scenario analysis. And here we'll take the difference of the interest expense and the net income. So how much we pay to bondholders and how much we pay to the stockholders. And then goal seek this to a value of 0 by changing the interest expense. So we can see that now we are paying equal amounts to bondholders and stockholders. So 33.33 in interest expense and 33.33 as dividends to stockholders. But wait a minute, we had to actually get earnings before tax of 41.67 to be able to give 33.33 to the stockholders. And that is the tax savings advantage. Again, that's the illustration that tax savings is accrued on by bondholders, not stockholders. And that is example 11.1. Thank you for listening.